What's going on, everybody? It's Stas here. Welcome back to another video. So on this fine, beautiful Saturday morning, or maybe afternoon, depending on, or maybe even night, depending on when you're watching this video, we're going to be breaking down 3 hammered growth stocks that I'm looking to buy in 2022. Actually, I already bought one of them, one of which I already own. The other 2, I'm super close to buying. So before we break these stocks down, get your free money from Moomoo. You get 1 free share of NEO, guaranteed, and up to 5 other stocks, each of which could be valued up to $3,500. Just use my link down below, deposit at least $100, and boom, you get your free money. And with that being said, let's break down these stocks. So for stock number 1, drum roll please, we got good old Adobe, ticker symbol ADBE. And this is one that I didn't talk about for a couple of months on my channel because, quite frankly, it was way too overvalued. I mean, look where it was just a couple of months ago. Back in November, it was around $700 a share. So I think in November, December, even in January, February, I didn't talk about Adobe at all because it was coming down. And now I figured, hey, middle of March, we mentioned it last week. I want to talk a little bit more about it in this video. Now might be a good time to start watching it a bit more closely, considering it is down from $700. Now it's at $440. It is down 37% from that all-time high that was hit back in November. So right now, Adobe, with this 37% drawdown, it's sitting at a $208 billion market cap. The PE, trailing 12-month P, is about a 44, which is still a little bit lofty. I'm not going to lie, guys. I would like that down to about a 30, 35. I mean, best case scenario, a 25, but that's asking for a lot considering, again, it's at 45 now. Anything is possible. I mean, it could go down under 20 for all we know. Nobody knows what's going to happen, but right now it's at 44, and it going down to 25 might be a bit lofty, but a 35, not too lofty, honestly. That's very possible here in the short term. They did about $10 in EPS over the last 12 months, and the last 5-year revenue growth, I looked at the data right before filming this video, guys. It's sitting between 20 and 25% every year, except for one off year in 2020 when they grew about 15%. So they're growing 20, 25% year in, year out, only one off year, and an off year is 15% growth, which is still pretty solid, and that was in 2020 when we obviously had a very rocky year. And if you guys don't know about Adobe, well, let me tell you a little something about Adobe. Adobe is a very, very sticky business, probably one of the most sticky businesses of them all. When you use their products, you're not going to get out of that rabbit hole. I don't even want to call it a rabbit hole like it's negative. The products are fantastic, but once you start using them, you are very entrenched in those products, and there's really no competitors out there. Trust me, when I use Photoshop for the YouTube videos, or not the videos, I guess the thumbnails, and when I do other graphics for certain things, Photoshop is unmatched. It's fantastic. When I edit videos, I mostly use iMovie, but I could also use Premiere. Premiere is a great product, and there's so many other ones. Adobe After Effects, Adobe Illustrator, and the list goes on. Once you have these products, and you could pay for them individually, right, guys? You could pay. Let's say you don't want the suite of products. You don't want all 10, 12, 15 products. I don't even know how many they have at this point, but you don't want all of them. Maybe you just want Adobe After Effects. Maybe you just want Illustrator or Premiere, or maybe just Photoshop. You can literally just buy one of those on a monthly recurring basis. So let's say you want to buy Photoshop. You pay $20 a month. Boom. Photoshop is yours. You want Adobe After Effects. You pay $30 a month. You want this, you pay this a month. That's how it goes, guys. And again, you can do the whole bundle, the whole suite of products, which I'm not exactly sure what that's sitting at, but let me tell you, they're making a lot of money. They're bringing in a lot of customers, and these people are paying, and they're not going to stop paying because, again, these products are ridiculously sticky. So number 1 is Adobe, ticker symbol ADB, and again, it's down 37%. It's finally getting to a point where I'm getting interested again, because at $700, there's no freaking way I'm paying $700 a share for Adobe. It was way too overvalued, and I mentioned that back in those months when we were talking about it months ago, right? And that's what you guys have to realize. When you're looking at investing, especially over a longer time horizon, what you pay is very, very important. It's probably the most important thing. What you pay is the most important thing. Obviously, I mean, picking a good business, not picking a crappy business, that's big as well. That's probably the most important, but overpaying could kill you. Let's say you bought Adobe at 700. It might not go back to 700 for a couple of years. It might go to 200 and then take 5 years to get back to 700. You know, overpaying is very, very, it's crucial not to do it. Let's just put it that way. And that's why I'm being very cautious and patient with this, and why I would want it at a $300 stock price, $350. You know, that's where I would consider beginning to buy it. So ADB, I'm watching it. You guys can see on the max chart, this is a very, very healthy pullback, and on the 3-year chart. So this is good. Now we just have to wait and see what happens in the upcoming week/months, right? So stock number 2 is good old Shopify. So I don't think I mentioned this in the beginning of the video, but I own 1 out of the 3 stocks here. Again, I don't own Adobe. I just told you guys that, but I do own Shopify. I initiated a position a couple of weeks ago. Let me show you guys here on the 20-day chart when we ran up to about, well, I didn't buy when we ran up. I bought it, I think, at about 650, and then we saw a big drop to about 510, and I did not add more, guys. I'm being very patient here. You know, if I don't get to add at 500 again, so be it. But I'm not trying to rush into this position, try and build it out in a week or 2 weeks, 3 weeks, because, again, I just initiated a position. Now I'm going to give it some time and give it a couple of months. I probably will build this position out over the course of 2022. You know, I don't want to make it a huge position either. Let me mention that. It's going to be a smaller position, and I'm probably going to buy, you know, 3 or 4 separate times. But again, I'm not trying to rush it, because there's no need to rush. For all we know, we could be in a bear market for the rest of 2022, and this stock could go down way lower. So again, no need to rush. And as of now, Shopify is down way more than what Adobe was down. Again, Adobe was down, what, 37%? Shopify from 1760 to 510, which it just hit earlier this week, this stock went down 70%. You heard that right, 70%, guys. Unbelievable. And back then, no doubt Shopify was overvalued, but now that it's down 70%, I don't think it's overvalued anymore. I don't think it's extremely undervalued to the point where it's 10 cents on the dollar, but I think it's way closer to fair value now than it was a couple months ago. Obviously, it might even be getting to a point where, depending on your valuation models, it could be getting undervalued, you know, depending on who you're talking to. So at this point, $81 billion market cap is where it's sitting, 28.6 trailing 12-month PE, with earnings over the past 12 months, earnings per share being almost $23 per share. So this is a profitable company. The PE, again, being 28, is at a very interesting level considering the revenue growth that this company has seen over the past couple of years. I've done the math and I looked at the stats before this video, guys, so trust me, revenue growth over the past 5 years, get this, on average is 64.46% per year, guys. Let me say that again, 64.46% per year. This company is growing like a weed, and of course, it's not 64% every year over the past 5 years. That's the average. I think in 2020, they grew 80%. They had a year where they grew 50%. They had a couple of years in the 60 to 70% range. And don't just take my word for it, even though I just looked at the numbers before this video, go check it out for yourselves. You'll see how quickly Shopify has been growing, and now they're profitable. This is a very, very good step in this company's, life cycle, right? It's growing a lot. It's starting to become profitable. I'm loving it. And if you guys take a look on the 3-year chart, it's a very healthy pullback. What we're seeing on the max chart, it makes sense. It's a healthy pullback. And Shopify, in terms of the business, we all know Shopify is one of the best out there. You know, of course, there's other businesses that compete with Shopify. I mean, there's business competition everywhere in terms of all these industries that we talk about on this channel. But I believe Shopify is cream of the crop. I think if you are a mom and pop's business, you're just starting out, or you have a well-established business, brick and mortar, and you want to have, some online exposure, Shopify is the best way to do that in terms of building an e-commerce store, all the back end, all that good stuff. I've done it before. I'm not doing it anymore. I don't have any Shopify stores anymore, but I used to do that. and it's a great product, and I love it. And I think overall at these points, again, it's not a 10 cent on the dollar deal. It's not at the point where it's ridiculously undervalued, but it's getting there. And for it to be ridiculously undervalued, I would say, you guys might laugh at me, but 100, 200, 300 bucks a share, if it did cut another 50% from where it is now, that would be disgustingly undervalued, but I don't think that's going to happen. Anything could happen, but I don't think that's going to happen. So that's stock number 2, Shopify. And the last one, stock number 3, which admittedly is the one that I've done the least research on, but I know a little bit about it. It's Spotify, ticker symbol SPOT. And like I mentioned, guys, I don't own Adobe. I do own Shopify, a small position that I want to add more to, and I do not own Spotify. So Spotify has been hit very aggressively over the past couple of months, which is why I am looking at it now. And that's the thing, guys, when stocks go down, that is when you want to buy them. I'm not telling you what to buy, but when they go down in general, that's when you want to buy. That's what people don't get. I mean, people obviously understand that, but at the end of the day, people get scared when stocks go down. But that's when I get excited. That's when I personally get excited. So this stock is down, 56%, 55% over the past couple of months, and they've had some heat, the whole Joe Rogan thing. We're not going to get into that. Obviously, competition with other, platforms, Apple, this, that, the third. And of course, there's always going to be competition. But overall, this company is at a pretty interesting valuation. Right now, the market cap is sitting at about $27.7 billion. They have no PE because they are not profitable. And they have about, EPS trailing 12 months. Like I said, they're not profitable. They're losing about $1.12 over the last 12 months per share. And their price to sales, which is insane, guys. Price to sales right now is a 2.7. Very, very low for a company with this much growth. And in terms of their growth, revenue growth average for the last 5 years is just a hair under 30% per year, guys. So that means the average from 2017 to now each year is 29, almost 30%. So they're growing very aggressively. The stock price is down 55%. Price to sales is looking pretty solid at 2.7. I mean, that's pretty low in terms of price to sales. If this company magically, let's say they magically made a profit or they were profitable, just on them being profitable alone, I think this stock price would be a lot higher. I think the fact that they're unprofitable is a huge reason as to why it's gotten butchered to these low levels, because again, the price to sales is getting very low for a stock that's growing revenues as much as it is, and they're going to continue doing that into the future, in my opinion. Sure, the revenue growth will slow down at some point, but right now, it doesn't look like it is. So we're going to be watching Spotify over the next couple of quarters to see what's going on with them. And this is probably the one I'm least excited about, but I figured let me still put it in this video. Obviously, Shopify, I'm super excited about. I think Adobe is by far the best business out of all of these, if we're being honest here. But what you pay, price is what you pay, value is what you get. So we got to pay the right price. And, it's just not at the right price yet in terms of Adobe. It's a great business, but it's not at the right price. So we have to wait. And overall, that's it, guys. Overall, that's it. Quick little video here. We're about, 15 minutes in. I guess not so quick. But hey, hope you all found some value. If you did, hit the like button, subscribe, drop me a comment, and make sure to join my Patreon if you want all my buy, sells, call outs, morning videos, more access to me. That's linked down below. And get yourself some free money from Moomoo. You get 1 free share of NEO guaranteed. That ends at the end of March. So get that free share of NEO. And on top of that, you get up to 5 stocks, each of which could be valued up to $3,500. It's free money, guys. Use my link down below. Deposit at least $100, and boom, you get your free money. I'll catch you all in the next video. Thanks for watching. As always, peace out.